Hello everybody and welcome back. I've been a busy bee these past few months. And yes, I mean trying to make my queen bee happy, like any good worker bee. And also setting up my new Taxable account. In this video, we'll go over my stock picks, how it's performed over the last 3 months, and as always, I'll give an update on my TFSA. If you find this video interesting, please give it a thumbs up. Every time someone clicks the thumbs up button, a dividend gets increased. Now let's get into it. Now that our TFSAs are maxed out, I was faced with a question. What next? The obvious answer, supported by the financial experts on Reddit, was to open up an RRSP, a Registered Retirement Savings Plan. And generally, I would agree, but I instead chose to dance to the beat of my own drum, and instead open a taxable account. I decided on that for 2 reasons. First, I already have a pension where I'll be making around most of my regular income anyways, so the tax savings in an RRSP will be marginal. And second, I wanted the option to withdraw funds if I so choose. Now I'm really big on reinvesting dividends and making my portfolio compound, but I like the idea that if I wanted to, I could save up for a few months and use that money to pay for a vacation for me and my loved ones. But before I go and open the account, I want to think about what this account should look like in 5 years. For the majority of the people out there, they should be investing in broad ETFs that are passively managed. They provide wide diversification at a low cost and in general outperform actively managed portfolios. But because I'm using money from my HELOC and paying interest monthly, I do need a higher yield than most ETFs provide. This setup is also called core satellite investing. So in 5 years' time, I want my account to be around 50% core ETFs and 50% dividend stocks. And that's what I've done in my TFSA. My core ETFs are VEQT and VFV, while my satellite stocks include Enbridge, RioCan, Bank of Nova Scotia, and Bell to name a few. Those satellites give me dividends that not only cover the interest in my HELOC, but provide me extra money that could go into my core ETFs. I want the same setup for this taxable account, but remember, this account is focused more on income rather than growth. To that end, my core ETFs will be VDY, Vanguard's Canadian High Dividend Yield ETF, and XHU, iShares US High Dividend Yield ETF. Then, for my satellite stocks, I went heavier into the split share funds and covered call ETFs. These type of funds use leverage and write covered calls to generate higher yields than would otherwise be possible. If you'd like more information on covered calls, I discuss how they work with an example in episode 3. I'll link to it in the description below. The downside is that these stocks or funds don't appreciate in value. Their goal is to provide income, and that's exactly what I want. After some DD, research, and cherry picking the ones I like, I chose 18 different funds for diversification, putting 5K into the ones that have increased in value and 3K into funds whose share price have plateaued or have depreciated very slightly. And the yields on these are pretty impressive. They range from ZWG's 6% all the way up to FFN's 18.6%. Now you may think that's chasing yield, but that's not the case with funds like these. Let's imagine a fictional business. They're in financial trouble due to poor management, and in order to raise funds, they increase their dividend yield to 23% in hopes of attracting new investors. 23% is not sustainable for them, and in the coming months, they cut the dividend yield. And you're stuck owning a dying company. That's chasing yield. In the case of FFN, the high yield is due to cover call writing and leverage for more exposure to the underlying shares, not because the company is at risk of bankruptcy. Another interesting fact, FFN is currently at $7.51 per share and has a current distribution of 11 cents per share. That means after 5.5 years, you would have made your money back. Then for each following month, for the rest of your life, their dividend is free money. But you need to be aware that with these type of funds, dividends are not guaranteed. If the price falls below a certain value, they won't pay a dividend for that month. How often does this actually happen? In the case of FFN, in the past 9 years, they missed a total of 18 out of 108 months, all during bear markets. I don't like the fact that they missed those months, but for a high yield, I think it's worth it. And remember, we're not YOLOing all of our money into a single split share fund. We are diversifying into several others as well. Let's look at another one, SBC from Brompton. This fund holds the top 6 Canadian banks and uses both covered calls and some leverage to boost returns. Their chart looks great for a split share fund and has a yield of 8%. It's no 18%, but FFN was just one fund with the highest yield. Most of the ETFs I chose are around 8%, still very attractive. And as you can see, they didn't miss any months during the COVID crash, and their dividend remained consistent. I'm very happy to have this fund in my portfolio. But again, just be aware that it's possible for a fund like this to miss a payout date. And to compensate for the less than 100% payment frequency, I also put money into other blue chip companies such as Algonquin Power, CIBC, Canadian Utilities, and Manulife. These companies help balance those split share funds by having a more reliable dividend payout and will appreciate in value. So in June 2020, I opened up my cash account, and much like my TFSA, I started putting money in at a conservative rate. Well, okay, not so conservative. I started with a principal investment of $120,000, and after 4 months, the current market value is $128,271, thanks to price appreciation and reinvesting dividends. Yeah, we didn't go on vacation just yet. The average yield is 8%, and I'm currently receiving an average of $825 per month in dividends while paying $265 in interest, netting me an extra $560 per month. You know how when you get to the end of the month and people say, "I can't believe the month is almost over." I feel like, yeah, it's great. That means another month of dividends is just around the corner. Cheers. Now let's take a quick review of my TFSA, although not much has happened. In my last video, my market value was $200,000, and I was collecting an average of $844 per month in dividends. 4 months later, the market value has increased to $210,000. And my dividends have stayed the same because I've been reinvesting into growth ETFs, namely VFV and VEQT. I decided to make things simple and invest in VEQT, which has equities from all over the world. But to give the strongest economy in the world more weight, thanks America, I'm also adding some money in VFV. And there you have it. Both accounts have been performing exactly as I had hoped. If you'd like to see how these keep performing, please like, subscribe, and leave a comment. Thank you all for watching, and until next time.